Good morning, everyone. We are live. It's the Wealth Space Super Contributions webinar. This is our first webinar for the year. Before we get started, we would like to acknowledge that we are hosting this webinar on the land of the Gadigal people of the Eora Nation, the traditional custodians of this land, and pay our respects to their elders, both past and present. We also acknowledge the traditional custodians of the various lands on which you all join us from today, and pay our respects to all Aboriginal and Torres Strait Islander people joining us online. We're going to just run through very quickly a bit of housekeeping for the webinar. So there should be a housekeeping slide on your screen at the moment. To start, everybody is on mute, but we will be accepting questions throughout the session, and you can submit these using the question tab. We'll try to get to as many questions as possible, but we do have a lot of content to get through today. So if we can't respond to your question, we will follow up after the webinar. If you're experiencing any technical difficulties, please click the support button, which is one of the bottom tabs on your screen. And finally, the session is being recorded. So everyone who's registered will receive a follow-up email, and that will contain the slides, a link to the recording, access to other webinars in our series, and contact details for Sulo and myself. Also, just a very quick general advice warning. So the information discussed today is general in nature. We don't know your personal circumstances, your needs, goals, or objectives. So it's not to be constituted as legal or financial advice. Presenting today, myself, I'm Kelly Kennedy, a wealth advisor and director here at BDO Private Wealth Advisors, and I am joined by Sulo.
Hi everyone, thanks Kelly for the little introduction there. I'm Sulo Kulendran as works in private wealth at BDO in Kelly's team. And what you were about to see is very relevant in our world of superannuation and retirement planning. So today what we're going to cover are superannuation concepts, the contribution types and the limits. We'll also cover some strategies that we could consider or we would be considering, some tips for super hygiene, as well as accessing super.
Okay, great. So we'll get everything underway. I think it's really important to make sure we're all just starting on the same footing ground. So first we're going to just talk about a couple of the concepts that will be referred to in and out of today's content. So it's good that we're all on the same page. So first, what we're talking about is accumulation versus retirement mode. Superannuation is one big bucket, and under the hood, you can have different phases that you are in. So, accumulation phase, that's while we're working, we're still building up our superannuation balances, and we don't necessarily have access to it. That pot, we call that the accumulation phase, and that's taxed at 15%. So, internally inside that little pot, all the earnings. So, if what your super is invested in earns income or distributions, that's taxed at 15%. If you sell an investment in your super and it makes a profit, that's taxed at 15%. Then we have retirement phase. We really like this one because that's taxed at 0%. And there is a government legislated minimum that says you have to pay an income stream. The amount varies per age that you are, but they're the two main modes, accumulation phase, retirement phase. They're both what we call superannuation. Then we have the total super balance. So this is the amount of money you have in the super environment all up. So it's the combination of your accumulation phase and your retirement phase. We use this to determine your eligibility for different contribution types and for strategies, a lot of which we're going to cover today. Then we have the transfer balance cap. So total super balance, TSB, transfer balance cap, TBC. We love our acronyms. TBC, transfer balance cap, that's the limit on how much of your super you can actually move into retirement phase. The limit is currently 1.9 million, and this is going to increase to $2 million on 1 July 2025. The transfer balance cap comes into play, just say you have $2.5 million in the super environment. The maximum that you can actually transfer into a retirement phase pension is related to the transfer balance cap. So currently 1.9 going up to 2 mil on 1 July. Next slide, Sulo. Now we'll start talking about the actual contribution types and their limits. Can I have the next slide, please? Thank you, Sulo. There are two very distinct types. So first we have our pre-tax or our concessional contributions. This is money that generally hasn't been taxed yet. There is an exception for voluntary contributions, which we will discuss in detail coming up. But think of concessional as money that's you haven't paid tax and it's maybe your employer making contributions, things like that. When it goes into the super fund, your super fund taxes it at 15%. Under the hood, these contributions form part of the taxable component of your super fund of that account. And the current limit is $30,000 per financial year. So that's concessional. Then we have what we call post-tax or non-concessional contributions. So this is money that has already been taxed. For example, it could be money that you've received from your employer, already paid tax on it, sitting in your bank account. When this money goes into super, it's not taxed. So the super fund won't tax it. Under the hood, this forms part of the tax-free component of your super account. The limit is currently $120,000 per financial year. So that's just a brief introduction to the two distinct contribution types, and we're going to go into more detail coming up. Next slide.
Thanks, Kelly. Now, on the other end, once you've placed that money into super, you may be thinking, well, what happens if I do want to draw on these superannuation benefits? There will be some tax payable in some circumstances. So as it says there in quite a lot of words, but basically your taxable, firstly, there's a tax-free component and a taxable component. The tax-free component, as it says, is tax-free once you receive those benefits, once you reach what we call conditions of release and preservation age, which we'll cover off if we've got some time later on. But if there's a taxable component in your superannuation fund, if you're over the age of 60, again, there is no tax payable on the amount drawn. If you're under the age of 60, the whole amount that's drawn as a lump sum is going to be assessable income and taxed at about 20%. Medicare levy may also apply on that, at that time. If there's an untaxed element within that taxable component, if you're over the age of 60, the first 1.78 million is assessed at 15%, and anything above that is assessed at 45%. If you're under the age of 60 and have that untaxed element within the taxable component, the first 1.78 million is taxed at 30% and the remainder at 45%. Again, Medicare levy may also apply at this time. Now let's cover off in a little bit more detail the concessional contributions. So what are concessional contributions? They can be employer contributions, salary sacrifice contributions, and voluntary contributions. So employer contributions, that's your super guarantee rate or your SGs that are going in currently at 11.5% of your superannuation salary. This will be going up to 12% come 1 July this year. There's actually no age limit on compulsory employer contributions. Now let's talk about salary sacrifice. This is where you can put in place an arrangement before you're actually entitled to the funds and you speak to your employer regarding this. You can make salary sacrifice or pre-tax contributions into super until 28 days after your 75th birthday. Then there's voluntary contributions. You can make the contribution to super yourself, then claim a tax deduction. You need to ensure that you have sufficient taxable income to actually warrant the deduction. Otherwise, it will get rejected by the ATO. You can make these contributions again 28 days after the 75th birthday. So up until then, you can make these contributions. However, in order to claim a deduction, this part's really important. To be able to claim a deduction, you need to be for people between the age of 67 and 74, you need to be able to meet a work test or a work test exemption, which I'll get onto next. So what this work test is for people above the age of 67 and before 74, between 67 and 74, is you're gainfully employed for at least 40 hours during a 30 consecutive day period in a financial year in which the contributions are made. It's an annual test, and once you meet the test, it applies for the whole financial year. If you do any unpaid or voluntary work, if there's any passive income coming through, that actually doesn't meet gainful employment conditions. So that's the work test. If you are subject to the work test, but you no longer meet the requirements as above, if you no longer meet the work test, you can still accept, the fund can still accept voluntary contributions for an extra 12 months from the end of the financial year that you actually last met the work test. So there's 3 conditions. You need to satisfy the work test in the financial year before the year in which you made the contribution. Your total super balance that Kelly mentioned earlier, so what's in both phases of super, is less than 300,000 at the end of the previous financial year. And then you did not use the work test exemption in that previous financial year. So you've got to meet these conditions to apply the work test exemption if required.
Now we'll just run through a nice example about concessional contributions. And we've got Michael here. He's an account manager. He has a base salary of 100,000. So based on that, his employer will pay SG of 11,500. So his total package is 111,500. So if Michael wants to increase his concessional contributions for a financial year, he has choices. He can either establish a salary sacrifice arrangement, or he can do voluntary contributions. So just a little bit about the mechanisms here. If he does a salary sacrifice arrangement, he actually has to do that in practice with his employer before he's entitled, as Sulo said before, and then it will just automatically come out of his pay. In this situation, he has it's taken away from him. It's already done. He doesn't have to think about it. He doesn't have to go and make the additional contribution, and it will just go to the super account that he nominates. One of the benefits of that is the discipline. He doesn't have to think about it. It's just done for him. The downside is when your employer makes the contributions, they do it in the time that suits them within legislation. So, and your contributions that count for a financial year is based on when the super fund received the contribution, not when it was entitled to or when it was paid, because there could be a delay in the two. So it could end up that he ends up being under the contribution limit, or he could end up being over, depending on the timing. So another way he can do it is the voluntary contributions. In this situation, he does receive the money from his employer, and it just he pays tax at his marginal tax rate, and then it sits in his bank account. And then the way he does it is he actually then deposits the money to his super fund. He also then gives them a form. The form normally happens the following financial year. So just say we're going to do it this June. He makes his contribution. He deposits in, depending on the BPay or bank details of your super fund. In July or post-July, he can give what's called a notice of intent to claim form. So he gives that to the super fund. They give you back an acknowledgement. You give that to your accountant, and that's how the tax sort of works itself out. If you just go to the next slide, please, Sulo. So in both situations, salary sacrifice versus doing it yourself, the net result should be the same as long as the timing is there. So this these calculations of what we're showing you here is on the middle column is no additional contributions to super. So you can see his salary, we've taken out tax and Medicare levy, and you can see his net income, 77,212. Then what we're doing on the right-hand side is showing you if you were to do some either salary sacrifice or voluntary contributions. So we've said, okay, Michael, you want to take yourself up to the contribution limit for this financial year. Maybe he's in the mid-50s working his way towards retirement, so super is a priority for him. So he does 18,500, that takes him up to the 30,000 limit. This reduces his personal tax. You can see it goes from 22,800 odd to 16,000, just under 16,900. So his net income is 64,632. He's saving about 5,900. But we don't want to say that that's the total benefit to him, because we need to take into account the 15% tax when this money goes into super. So in the middle here, you can see the amount of voluntary contributions, 18,500. The tax on those contributions at 15%, 2,775. So the net contributions in the super fund are 15,725. I have excluded the SG contributions of 11,500 because they would be the same in either scenario. So then we go net income and net contribution, 80,357. When we work it out, the net overall benefit to Michael is 3,145. So we've taken into account he's reduced his taxable income. He has paid a bit of tax. So for someone on a marginal tax rate above 15%, this can be a good strategy if it makes sense to you. Not every strategy we talk about, just because you could do it doesn't mean you should do it. You should seek financial advice. Next slide, please. There's also something called catch-up concessional contributions. So the government said if your balance is less than 500,000, you may be able to take some of the unused portion from previous years and put them in one financial year, or use them moving forward. So they're a rolling 5-year period. It came into place from 1 July 2018. So any contribution or unused contributions, from the 18-19 financial year, unfortunately, because it's a 5-year thing, they've dropped off now. So any unused contributions from the 19-20 financial year, they're currently still in play, but that will drop off as at 30 June this financial year. So something to be aware of. But how it works is, and you can see on this table here, you've got the financial years, and in that first line, you've got the limit of that financial year. So it's not the current limit, it's the relevant limit from that financial year. So back in 1920, the limit was 25,000. So just say this person never used any of them, they didn't have any contributions go in, the limit accumulates. So 1920, we've got 25,000 unused. In 2021, the limit again was 25,000. If they didn't use it for either, their cumulative limit is now 50,000. And then it just keeps growing over time for rolling 5-year periods. If you go to the next one, please. So we then thought, okay, what about Michael? How does that apply to him? So based on his salary and working backwards, just say he had increases of 4% per year, I've worked out roughly, this is what his contributions would have been. That's the top level, so that's his employer contributions. Then we say that's the limit in the next line for the financial year. Then we go, what's your unused portion? So in year 1, 1920, he had employer contributions of 7,790. The limit for that year was 25,000. His unused concessional contributions was 17,210. So if we follow that premise for all of the years and get to the current financial year, the total cumulative unused amount is 106,115. Now, we said before, you need to have sufficient taxable income to warrant the offset. So even though Michael has unused portion of 106,000, including the current financial year, doesn't mean he necessarily should put all of that money in. Just say he had money sitting in a bank account and he was looking to put this in to super. It doesn't mean it should all go in as a concessional contribution, because you can't put the money in and then try to claim a tax deduction that's going to take you into a refund necessarily. So you need to just do the balancing act. In this one, you could potentially do, I think I worked out it was somewhere between 70 and 75,000 roughly. So you need to seek financial advice and work out what the right amount is. You should also check it with your accountant just to make sure. Something to be aware of is, as I said before, the 1920 financial year, that expires coming up in 30 June. So Michael might say, okay, you know what, I don't have enough taxable income to offset it all, but I'm at least going to put in the contribution from the unused portion from 1920 and my current financial year. Something to be aware of is Div 293 or high income earner tax. And if we have some high income earners in the room, I'm sure you're all aware of this and not in love with this particular additional tax. So what it is it's an extra tax on your super contributions of 15%, 15% if your income, taxable income, and your concessional contributions equal more than 250,000. So it's on the excess portion. You can pay for it personally or from your super fund. The way the mechanics work is your employer puts your contributions into the fund, you do your tax return, the ATO will then, once they're processing, they'll also receive something from your fund to confirm your contributions for the year. They then issue you a notice, and that's when you know how much your Div 293 tax is. At that time, that's when you can elect. You can either pay for it yourself or you can elect to release it from your super fund. So I've got 3 examples here just so we can see how it works. So example 1, Hillary has a salary package of 240,000 plus super contributions on top of 27,600. So her total for tax return purposes is 267,600. So what will actually attract the Div 293 tax? We take her total, the 267,600 minus the 250,000. She's 17,600 in excess. So 15% tax on that is 2,640. So in her situation, her entire super contributions, sorry, not the entire contributions are going to attract the tax, just a portion. Unfortunately, the majority, but still. And then we have example 2, we've got Billy. He's on 300,000 including super. So his taxable income 270 odd thousand. His super is just under the super contributions, just under 30,000. In his situation, the full amount will actually count for the Div 293 tax. So he will end up paying 15% of 29932, which is 4490. Example 3, just because you're not a high income earner all the time from your salary doesn't mean you might never be subject to the Div 293 tax. There are situations where you sell an asset. And so in example 3, we've got Sarah. She's got a salary that her super contributions wouldn't attract, or her total, she wouldn't be over the 250,000 threshold. But in this year, she sells her investment property, and after capital gains tax, discounting, etc., she's got a capital gain of 200,000 that's going to count in her tax return. So in this year, she will be subject to Div 293 tax. One of the strategies we talk with clients, and I'm not going to give too much away right now, but doing a concessional contribution and maybe using your unused portions in the same year you sell investment property. But we'll leave that for later.
Thanks, Kelly. Now, with those concessional contributions, there are limits that apply, as Kelly mentioned earlier in her slides. Once you go over the limit, once you exceed that cap, you will attract an additional level of tax once you're over that limit. And that's going to be included in your tax return, taxed at your marginal tax rate, less a 15% offset. That 15% is due to the contributions tax that's already being paid once it entered the superannuation fund. Now, you can actually elect to have up to 85% of those excess concessional contributions to be released from your superannuation fund. If you choose to leave that excess in the super, it'll then count towards what we call the non-concessional cap. So your pre-tax contributions, you have a limit. If you go over by even $1, that dollar will count towards the non-concessional cap. Let's get on to non-concessional contributions. So these are voluntary contributions that you do not claim a tax deduction for. You can make non-concessional contributions up to and including the year that you turn age 75, as mentioned earlier. The current limit per annum per financial year is $120,000. Now, bring forward provisions, which you may or may not have heard of, it allows you to contribute 3 financial years worth of non-concessional contributions in 1 year. So what that means is you use the limit for the current financial year, plus you can use the limit from the next 2 financial years to make a larger contribution in one hit. The total contributions cannot actually go over that amount. Otherwise, you will trigger the excess non-concessional contributions limit, which we'll talk through later. So we need to actually be very careful with planning how to make these contributions. As Kelly mentioned, there's a lot to consider when we're making contributions into super, but you need to make sure your non-concessional contributions are within limits. Consider what has been made previous financial years by going into the MyGov ATO portal. You can see your last 5 financial years of history there. You can also see your concessional contributions history there as well. So it really allows you to make sure that you're staying within these limits with breathing space. Now, with these bring forward provisions, we're looking at these bring forward ability. So we can put in $120,000 this financial year, bring forward the next 2 financial years, which makes $360,000 that we can place into super as an after-tax or non-concessional contribution in one hit. Now, if your total super balance in the previous financial year is less than 1.66 million, then yep, you're allowed to put in 360,000 in one hit. If your superannuation balance is between the 1.66 mil and the 1.78 mil, you can only use 240,000 in that financial year to contribute as using the bring forward provisions. If it's between 1.78 mil and 1.9 mil as at 30 June 2024, so just the previous financial year, then we're limited to just putting in the first year's contribution of 120,000. And if your limit is above that 1.9 million total super balance, we can't actually make further non-concessional contributions into the environment, superannuation environment. Now, come 1 July this year, that 1.9 million is going to increase to $2 million, which therefore increases these banners of thresholds. So it may actually be a consideration to say, hey, should I place the money in today or should I wait till 30 June 2025 so I can get that slightly higher threshold limit, which may allow me to get more money as an after-tax or non-concessional contribution into super. Just want to make sure I haven't missed anything there.
Just so you know, we got a question come through about the tax-free component and the income derived from non-concessional contributions. So when the contributions go in, they form their tax component, but their earnings is more on the taxable side. So hopefully that answers that question. So the non-concessional goes in as tax-free, and it just states you don't keep earning tax-free earnings on top of that. So all earnings go onto the taxable component. And we had a question about catch-up contributions. Do they have to be made as voluntary or can they be made as salary sacrifice? Yes, they can be made as salary sacrifice as well. You just need to make sure, I guess, that would be a much of a harder situation to control, because if you forget and leave your salary sacrifice arrangement in place, what if you end up going over? You also need to check your balance. Are you close to the 500K limit? So if you're one of the criteria is your balance needs to be under or 500,000 and under as at the 30 June prior. So you just need to manage a few more elements. So it might be harder. And I guess the third element would be your pay. If you're doing a large amount, what's the impact to your cash flow? Sorry, back to you, Sulo. Or is it me now?
Thanks, Kelly. Let me have a quick look.
Are we up to spouse contributions?
Spouse contributions, over to you, Kelly.
All right, beautiful. So Some another strategy that we can have within non-concessional contributions is a spouse contribution. So you might have two members of a couple, and one's earning more than the spouse, and maybe the other spouse doesn't actually have an income at all. You can actually contribute $3,000 to your spouse's super. It goes in and it's treated as a non-concessional contribution. So if you were doing this in conjunction with other strategies and the limit for non-concessionals is 120,000 per year, this counts towards that 120. You can't do 120 plus a spouse. So that's something to be aware of. So you could do 117 as a regular non-concessional and then 3,000 as a spouse. The benefit of doing this is tax offset to the contributing spouse. Maximum tax offset is $540, and there is criteria. So your spouse's income needs to be under $40,000 to get the full benefit. So it's a quick little one that we like to do for clients from time to time. And then over the page, we've got co-contributions. So if you make a non-concessional contribution of $500, the government may match this up to $500. There are criteria you need to meet. So it's subject to an income test. To get the full benefit, you need to have income of under 45,400. If you go over 60,400, you get no benefit at all. And then we'll just keep going.
I'm happy to do this one, Kelly. So going over the limit of your non-concessional contributions. Now we spoke about concessional contributions, what happens if you go over the limit there. Now we're talking about these after-tax contributions. Going over the non-concessional contributions, if you exceed the limit, you can actually elect to release the excess as well as 85% of the associated earnings. Now, the full amount of those associated earnings are assessable at your marginal tax rate, less a 15% tax offset. That's generally what the ATO will fall back on as their default option. The other option is to leave the excess in the superannuation account, but the excess is going to get taxed at 47%. Back to you, Kelly.
Okay, so now we're going to talk about downsizer contributions. So downsizer contributions, this is a one-off contribution up to a maximum of 300,000 per spouse, so 600,000 per couple. It can't be greater than the total proceeds from the sale of your home. So if your home was only 400,000, I mean, I don't think this applies to too many people these days with the way property is, but if the property value was 400,000 and you sell that, you can't put in the full 600,000. You could only put 400,000 total. It doesn't actually count towards the contribution caps. So, and you can do this regardless of your super balance. So the TSB, TBC, you don't have to worry about those here. They do form part of the tax-free component, so we like them for that perspective also. There are a number of criteria that you need to tick though. So you have to be over 55. You need to have owned the home, you or your spouse need to have owned the home for 10 years or more before the sale. It needs to be an actual home. It can't be a caravan, boat, or mobile home. The proceeds need to be exempt or partially exempt from CGT. So what that means is it can't be an investment property that it wasn't an investment property for the entire time of you holding that. If it was maybe used to produce income for a small portion or a portion, maybe that would be okay, but best to check. And really important on the timing, you need to make the contribution within 90 days of receiving the proceeds of sale. So if you're in that situation where you're thinking we're going to downsize, side size, upsize, whatever it is, even if you're upsizing, you can still take advantage of this to say you've got other assets outside, but you need to be really mindful of that 90 days. So great, sell your home, but maybe start the conversation and planning your contributions earlier in the piece.
Thanks, Kelly. I'll talk to you about small business CGT concessions. So if you have been running a small business and you've got turnover of less than 2 mil, and net assets of under 6 mil, they're the basic eligibility criteria to use these concessions. You can basically legitimately not have to pay capital gains tax. So some of the ways that these small business concessions can be used is there's basically 4 concessions, one of them being the 50% active asset reduction. So it automatically applies if these basic conditions have been met. It reduces your capital gain by 50% for assets used in the business. And that's actually in addition to the CGT discount. So you've got $1 million asset, you consider the 50% CGT discount, that takes it to 500,000. Then you apply the 50% active asset reduction test, concession, and that will apply an additional 50%. So your capital gain there is 25% of that 1 mil. There is another exemption, 15-year exemption. So as if you have held the business and owned it for more than 15 years, and if you are over the age of 55 and you can show a connection that you are retiring and you're over the age of 55, you want to sell this business, you've held it for more than 15 years, and you can contribute this money into a superannuation fund. It's the amount would usually be considered a non-concessional contribution, but we can actually elect to tick a box on the CGT cap election form prior to the contribution being made, which will allow it to be excluded from the contributions caps. Now, the maximum lifetime limit where this CGT cap where you can contribute this money under the 15-year exemption has to fall within this CGT cap of 1.78 mil for the financial year. Another way to utilise the concessions is a rollover relief. So it may be a younger individual who might be selling an asset in the business or selling the business, but they want to repurchase or restructure their business, and they are able to do that. So the small business rollover allows eligible small businesses to defer all or part of that capital gain from selling an active asset. So you're really deferring it out, rather than not having to pay it at all. If you acquire a replacement asset or incur costs on making capital improvements to the existing asset, these can be deferred until you eventually dispose of that asset. The small business retirement exemption. So the capital gains from the disposal of the active assets may be disregarded up to a lifetime limit of 500,000 per individual or the stakeholder. It could be for the company or trust as well. You may be able to use these amounts as contributions to your superannuation fund, again, without affecting those non-concessional contribution limits. Now, if you're over the age of 55, there's no requirement to pay any amount to a complying super fund. But if you're under the age of 55, this CGT exempt amount from the proceeds of the disposal of this asset must be paid to a superannuation fund. Counted as a non-concessional contribution unless you notify the fund to exclude the amount from the non-concessional contributions cap and have it count towards this CGT cap amount of 500,000 instead. Over to you, Kelly, to talk through some strategies.
Okay, great. I did see a question just come through about the downsizer contribution. The question is, if the house was only in the wife's name, can both husband and wife make the downsizer contribution, assuming all other conditions are satisfied? Yes, that's correct. You can both. Husband and wife can. Doesn't have to be in both of your joint names. So lovely. Thank you for the question. We are getting quite a lot of questions come through, and we do have a lot of content, so we might not be able to get to everyone's questions. Apologies, but as I said at the start, we will come back to you post the webinar. Now we're just going to run through a couple of strategies that we like to utilize for our clients. So first we're going to talk about getting a large amount of money into super in a short amount of time. If you just go to the next page. So we talked earlier about the non-concessionals and the bring forward. So if you have means, what we can do is just be a little bit clever with the timing. So rather than put triggering what we call the bring forward in the current financial year, we might delay that to the following financial year and just use the regular non-concessional limits this year. So on the left-hand side of this graph, you can see before 30 June, we've got a husband and wife, and they each do 120,000. So we're getting 240,000 in this financial year. And I'm saying before 30 June. So just say we could do it in June and July. Then it's a very quick amount of time to get a lot of money into super. So on the post 1 July side, husband does 360, so he's using 3 financial years worth, and wife is also doing 360, so a total of 720. And if we combine all of those together, that brings us 960,000 in the super environment in a very short amount of time. And if we're also lucky enough, we can then add in downsizer contributions potentially up to 600,000. So you could potentially be getting in 1.56 mil into super in a very short amount of time. Strategies we also like to think about just planning for the future and equalizing balances. So if you've got husband and wife, and husband's been a high income earner, or maybe the wife's been the high income earner, whichever the case, you want to protect against legislation in the future, so you want to try and keep your balances equal, but you also want to maximize the amount that you can put into the retirement phase. So if one spouse's balance is going to be potentially going over that limit, but the spouse's isn't, maybe you want to look at ways to move it from one spouse to the other. A very small way of doing this is I think it's not a very commonly known or commonly utilized strategy, is called contribution splitting. So this is taking 85% of concessional contributions and rolling them to your spouse's super account. So it can be used to reduce the contributing members' total super balance to enable contribution opportunities. You can't do a huge amount. So if you combine it with a year that you do unused concessionals, you can do 85% of those. And the reason it's 85% is we're taking into account the 15% that went to tax. But if you're just doing this as a regular strategy for a couple of years, you can move, even if it's a small amount, you could potentially be moving 60,000 from one spouse to another. And if you combine that with other strategies, it all adds up. I think the way couples might need to see it is it's not his and hers, it's our pot of money. So we're just doing strategies to help our pot. But yeah, it's a little known strategy that I think is worthwhile considering.
Thanks, Kelly. Another strategy that we tend to utilise is what's called the withdrawal and recontribution strategy. So from the withdrawal end, if you meet preservation age and if you meet a condition of release, which like I said earlier, if we have time, we'll touch on, you can access your superannuation benefits. You can then withdraw some money from superannuation, and then we can recontribute it back into the accumulation phase of superannuation. What that effectively does is increases the amount that you recontribute as an after-tax contribution. If you have the eligibility to do so, then you're actually increasing your tax-free component. And what this will eventually do is not only just increase the tax-free component for superannuation withdrawals for members under the age of 60, but will also minimise potential beneficiaries' tax payable when they receive their future inheritance at that time. So it does save on the tax that the beneficiary will pay, because depending on who that beneficiary is. So I'll talk through that next, actually. So when we think about inheritance planning, as parents, they work hard all their lives. They do want to see that benefit that they're not using for their own enjoyment to be passed on to the next generation and to a family member in the most tax effective way. So superannuation, firstly, does not automatically form part of your estate. You can choose what we call on a binding death nomination form. So it's a form provided by the superannuation fund where you can choose and elect your beneficiary. That beneficiary could be the estate as well. The tax treatment depends on the tax-free and taxable components of super, and whether the recipient is a tax dependent. So the tax-free component of your superannuation benefits passing on to a beneficiary, the tax-free component passes on tax-free. So there's no tax payable. The taxable component, if it is a dependent that is receiving that money, again, no tax payable. So if it's going to your spouse, there's no tax payable. If it's going to a non-dependent, so potentially the money may be being fed into the adult non-dependent child, there will be tax payable, 17%, including Medicare levy. If we chose a binding nomination and elected for the superannuation benefits to go to the estate, then there will be no Medicare levy payable. However, there is still tax payable by the beneficiary of 15%.
Just before we move to super account hygiene, there was one strategy we touched on earlier and actually didn't put in our slides. It's just around the timing of selling an asset or another CGT asset. So the biggest example we can use is selling an investment property. If your super balances allow and all the eligibility criteria is met, it could be a worthwhile consideration to sell the investment property in the same financial year as using the catch-up concessional contributions. Bit of mechanisms to play with, need to just make sure under 500,000, but it can help you reduce your tax liability and maximize your proceeds. So now we'll pop into super account hygiene. Just go to the next slide. So thank you. Okay, so this is applicable to anyone, everyone looking at your existing super fund, thinking about how is it doing? Am I in the right account? Or maybe you've got multiple accounts and you're thinking, do I consolidate? Some good hygiene things to think about: your investments, making sure you're actually aware of how your super is invested, and just making sure you look under the hood of those investments. So the word balanced is often used in most super funds, if not all. Balanced means a different level of growth and risk to each provider. So for one super fund, you might have 60% of growth in a balanced fund. The next fund, it might be 70% or 80%. It really depends. So you need to have a look, see what you're invested in, and make sure, is that commensurate with my risk profile for my own individual tolerance of risk, but also my stage of life. Maybe if you're younger, you can think about taking a bit more risk. As you get closer to retirement, you might want to dial down the risk a little bit. So it's just making sure you're making an active decision. Insurance. Do you actually have insurance in your account? So you can hold life, total and permanent disability and income protection, or a lot of funds call it salary continuance, through your super. So it's just having a review, going into your account, seeing, do you pay for it? Do I need it? Is it fit for purpose? What are the premiums I'm paying? And just say you're thinking about a consolidation, or maybe thinking about moving to another fund, you need to just be aware you can't take that insurance with you necessarily. There are the exceptions where you may be able to transfer it, but for the most part, you can't take that with you. So if you do have insurance and you need it, be mindful of that. Death benefit nominations. We see a lot of accounts with either no nomination or an invalid nomination. So super doesn't form part of your estate unless you tell it to. You can only leave your super to certain people, and there is a list of who we call a super dependent. How it's then treated is your tax dependent. Generally speaking, you can leave it to spouse, children, financial dependent. Unless they're a financial dependent or an interdependent, you generally aren't able to leave your super to your sister or your parents, things like that. So, and a super fund, it's not on the super fund to check the nomination at the time, because they might see the name and think, okay, yep, they're a spouse or a child, or they don't necessarily always have all the details. So you might think what your nomination is valid, but it might not be when it comes time to pay your death benefit. If you want to pay it to your friend or parent or sibling, you want to make a nomination to your estate. So that way it's dealt with as part of your will. Second to that, make sure you have a will in place. And then fees and features, things to consider, what fees are you paying your super fund? Are you paying for things that you don't need? Are you happy with the low frills, low fees option, but you're actually in a platform that's quite expensive because they give you all the bells and whistles? Do you want access to education and webinars, but you're in one that doesn't actually give you anything? So just some things to be aware of for just regular super, applies to everybody. And then Sulo is going to run through SMSF.
Thanks, Kelly. So specifically, if you've got a self-managed super fund, there are a few considerations that you need to be thinking about on top of what Kelly's already mentioned. The first one, in relation to your investments, review your investment strategy. We see a lot of trustees where the investment strategy hasn't been updated. It's good superannuation hygiene to really look after that on an annual basis to make sure that it's in line with your risk appetite and your preferences. It will come down to your risk preferences based on your age, what's happening in the markets, when do you need to utilise those funds. Now, liquidity considerations for pension payments, that's also another one that needs to be looked at when you've got a self-managed super fund. The mid-age group is really starting to purchase property inside superannuation, and that's becoming a focus at the moment within self-managed super fund land. What may become an issue later on is you've got this one lumpy asset. If people commence a pension later on when they're able to, are they going to have enough liquidity to fund those pension payments? So that's definitely one to consider with the accountant, and something that a financial advisor will look at as well. How old is your trust deed? Does it meet the current legislation? If it's been set up a long time ago, it may actually not reflect the legislation that's current. So that does need to be checked and reviewed. And one thing that we like to look at within a trust deed is, does it allow for the beneficiaries, can the spouse receive a reversionary payment? All of that will come through in the trust deed, so it does need to be reviewed, and basically with a bit of a magnifying glass. Now, within self-managed super funds, an issue that we're seeing is sometimes people don't think about the exit strategy. I've got a self-managed super fund, I'm going to keep it running, but what happens if one of the directors of the corporate trustee pass away? What happens if they don't have a corporate trustee and if it's in an individual trustee structure? If one person passes away, the other individual trustee is not actually able to continue to make decisions and run that fund because it becomes non-compliant. So it is very important to review that trust deed, think about succession planning, think about the what if events, and can this superannuation fund continue? Can we continue to make those pension payments? Can we continue to think about how these funds will eventually be transferred over to the next generation, if not used 100% by the members of that self-managed super fund. An important aspect of this is to ensure that you've got powers of attorney in place, so that if you lose capacity and unable to make financial decisions yourself, an enduring power of attorney, I should say enduring actually there, an enduring power of attorney can step in and act on your behalf when it comes to these decisions that will need to be made. So please, on top of your superannuation considerations, think about that estate planning consideration as well, and have that reviewed. Your wills and estate planning, powers of attorney, enduring powers of attorney, enduring powers of guardianship come into play as well. In specie asset transfers, so this is where you can actually transfer assets outside that it's held in your name into the nice superannuation tax effective environment without having to sell down that asset. As long as it will still count as a contribution, so you need to consider all these contribution limits that we've spoken about. On transfer, another consideration is the stamp duty and the capital gains tax event if the beneficial ownership changes. Contribution reserving. So this is a strategy used within self-managed super funds. If you've used your concessional contributions cap already in the financial year, you can still make a deductible contribution or a pre-tax contribution in the current financial year and claim a deduction in that year one. You can allocate the contribution to the contribution reserve prior to 1 July, but actually allocate the contribution to the member after that period within 28 days, so up until 28th of July, the next financial year. The contribution is included in the total super balance in year two. So that sounds a bit complex, but it is something that we have seen, especially around that end of financial year contribution strategies time.
We're almost pretty much out of time. So when you do receive the slides, what you're going to see is a couple of slides on accessing your super. So first is just about the actual preservation age, the conditions of release. So first hurdle, preservation age, second is condition of release. And then there's different pension types you can take and pension minimums. We don't have time to go through those today, unfortunately, but maybe that's an idea for a future webinar topic. There are a lot of questions that have come through. So for the ones we didn't get to, Sulo and I will come back to you. But just before we go, Sulo, I'm not sure what page we're on, but if you're able just to show the future webinar topics.
Yeah, sure.
So we are doing this regularly. It's close to bi-monthly. If we've got investing for not-for-profits in May. We've got Sulo's presenting on aged care in July, and then we're presenting on investment properties later in September. And as always, if you have any ideas or suggestions, please send them through. We're open to that. So just want to thank everyone for joining today. Thank you for giving us your time and attention, and hope you enjoyed.
Thank you, everyone.